Hello and welcome to BQ Prime. You're watching IPO Adda and my company focus is Sah Polymers. The company is coming out with an IPO which opens on December 30th, price between 61 to 65 rupees a share. They're raising fresh issue of 66.3 crores and the company is in the business of production of polypropylene and HDPE or FIBC bags. It's based out of Rajasthan, and joining me is Asad Daud, who is the managing director, and Murtaza Moti, who is the chief executive officer of the company. Gentlemen, thank you very much for joining us on BQ Prime. Let me take the first question to Asad. Asad, you're raising 66 crores. So what are you using this money for?
So approximately 8 crore rupees would be utilized towards the completion of the manufacturing facility of FIBCs. 19.66 crore rupees would be utilized to repay both secured and unsecured debt. A majority of these debt has been taken for commissioning and setting up of this manufacturing plant, and approximately 14 crore rupees will be utilized for working capital and the balance for general corporate purpose.
Just to get a clarification, you're making a new plant which is costing roughly around 34 crore rupees. And you've already invested around 15 odd crores in that plant through promoter debt, right? Now, the repayment of loans, which includes of 19.6 crores, does it involve repayment of the promoter debt as well?
Yes, that's correct.
So it will be paid out entirely, 15 odd crores?
Yes, almost entirely.
Oh, okay. What about the working capital requirement? Because I've been looking at your financials. You are on an operating cash flow basis negative for FY22 and Q1 of this year. How do you plan to generate cash for working capital as well as for future expansions?
So if you would see that the operating cash flow is negative on accounts of majority two reasons. One is increase in inventory and the other is increase in receivables. If you would have seen our growth over the past 1.5 years, we've almost grown by 50%. Also, we have increased our exports to the USA, and because of the transit time from India to USA is much higher as compared to a European country or even a Middle East or African country. That is the reason why we have increase in the receivables. Also, increase in inventory is on account of higher sales has led to higher working capital requirement. So that is the reason for the negative cash flow from operations.
When do you see this restoring itself?
Pardon me, sorry?
When do you see this restoring to become positive?
So we expect that once our new plant is fully operational and running at optimum capacity, we'll be generating a positive cash flow from operations.
Murtaza, when do you see this happening? What kind of capacity you're working on currently, capacity utilization, and once the new plant comes in, and when does it come in? How much your capacity will go up by?
Yeah, at this stage, we are operating at a 4,000 metric ton of capacity, approximately 4,000 metric ton per annum capacity. And our new plant will add to another 4,000 metric ton. And our capacity utilization at this stage for existing plant is in the range of 80 to 90%. For industry standard, it is actually 100%. The reason being, the capacity is calculated in kgs in terms of tonnage, but the actual production on loom is in meters. So when we are producing finer fabric, the capacity in terms of tonnage is lower. But that doesn't mean our capacity or our machine is kept idle. It is actually working fully, operating at 100% capacity. And as far as new capacity is concerned, we have already done a seed marketing, and our existing clients based in Europe, USA, they are in need of FIBCs and the new product. So we are expecting the new capacity would be utilized optimally very soon.
Okay, so if I look at your sales, Murtaza, nearly 53% comes from domestic, 46.4 comes from exports. How do you see exports faring from here on? Because in the last few years, the exports have fallen from 50 odd percent to 43%. Do you expect of the total sales going forward, exports again to pick up and become a sizable chunk?
Yes, so we are expecting export to pick up further because the reason being, we do have an, like if you see a concentration in the domestic market, it has grown over time. But we are expecting in the future the export market to pick up because our existing clients, they were in need for the new or the high end of FIBCs, which we will be producing in our new facility. So we were concentrating our existing product in the domestic market, but the new products will be towards the export because we are getting the demands for the export market, but because we didn't have the capacity, so we couldn't supply it.
You know, Asad, coming here, you are looking at a domestic market expansion as well, but there are restrictions in that you have, you have a promoter company which is competing with you in the same market for FIBC. I saw that in your risk factor that, though you have a non-compete now coming in, what is the chances that, that non-compete will stay? And there is, of course, two promoter companies competing in the same states, at least in Rajasthan and Gujarat, which are the big states for you.
So yeah, so currently we have so Sah Polymers Limited is into FIBCs, and its subsidiary Fipcorp Polyweave is also manufacturing FIBCs. I would say rather than compete, it is more about collaboration, wherein Fipcorp caters to a different set of FIBC products, and Sah Polymers caters to a different type of FIBC products. So it is actually collaboration rather than competition. In Sah Polymers, we're looking to manufacture high-end FIBCs, which are used in food industry, pharma industry, which are very high and very stringent requirements. And in Fipcorp, we are making most of industrial bags, which are used primarily in construction and mining and mineral industries.
And how do you see the domestic market growing? Because you are currently present in 5 states in India. So how do you see this expansion growing?
So currently, like you mentioned, that we are in 5 states right now. We already have, we are planning to increase in other states of India as well. The market for FIBC in India is still at a pretty nascent stage. In FIBCs, the demand is more from the export end and less from the domestic end. However, in the PP bags and the BOPP bags, there is a huge demand in India as well. So we will be having a nice mixture of domestic and export market, which ultimately helps the company in the long term.
If I look at the kind of your top 10 customers, they account for roughly around 61-62% of your total sales. Going forward, how do you plan to de-risk yourself from this, considering the fact that it's a very highly competitive market, price-wise and margin-wise?
So, as you can see, our concentration or our revenue from the top 10 customers have gone down. It was 79% approx in financial year 2020, which has gone down to 61%. And as we are expanding, we are exploring new markets and with a new product range. So our concentrations will be expanding. Our market range will be expanding further. At the same time, so when we say in a domestic market, our concentration is in Rajasthan, but the end use of our product is not in Rajasthan. Basically, we are supplying our bags to cement company, fertilizer companies, and mineral processing units, which is based in Rajasthan. But these bags or these materials are actually going out of Rajasthan and it's exported. So the end users or our geopolitical risk is not limited to Rajasthan, but basically to the outside area, outside Rajasthan.
And how do you see competitive pressure, pricing, especially in this market?
So we have a very strong R&D team. At the same time, with this expansion and collaboration with the Fipcorp Polyweave, our product basket is going to increase significantly. So we have these options of supplying mixed container load to customer and continuous R&D. We are developing new products and a cost-effective products. At the same time, the ability to supply mixed containers and to giving us a kind of an edge to compete with our competitors, and become our customer preferred supply.
How do you protect margins in this environment? Because in FY22, you had a margin of 8.7% EBITDA margin, and in the first quarter, it was 7.3%. I'm sure the cost pressure and the margin raw material pressure is one of the reasons. So how do you hedge against such thing?
So whenever we get any orders from the export market, we immediately book the raw material against that order. So this helps us to certain extent to overcome the risk of fluctuation in the prices of raw materials. With regards to the conversion cost, we are always looking to optimize our cost in a way that both our customers and we benefit, in the sense that we have a lot of discussions with our customer in order to educate them how they can reduce their packaging cost and also be environmentally sustainable. And that is how we maintain our margins.
So what percentage of your raw materials are coming in from domestic market and what percentage coming from international or overseas?
So we predominantly buy raw material from Reliance Industries under the deemed export license, because we are an exporter. So we buy from Reliance Industries. So I would say that 50 to 60% of the material comes under the deemed export and the remaining from the domestic market.
Okay. And but that would have given you the even cushion, good cushion for margins, right? But why is your margin suppressed in that sense in Q1?
So the margins. So in the last few months of this, especially in the first quarter, because of the Ukraine-Russia war, there has been significant fluctuations in the raw material prices. So sometimes it goes beyond our control to control the prices of raw materials. We try to the extent possible to maintain the stock and to ensure that we don't face any issues. But sometimes it goes beyond our control.
And are you able to pass on this increase in raw material prices to your end customers?
Yes, yes. So in our industry, so we generally don't have very long-term contracts. We generally have contracts ranging from 2 to 3 months maximum. So all the increase in the raw materials are passed on to the customer on the new orders.
What is the kind of order book you're sitting on?
We have an order book. Generally, our order book ranges between 2 to 3 months.
And then it's a rolling order book, is it?
Yeah, it's a rolling order book.
And you don't have fixed contracts with your suppliers, with your customers, given the fact that you have long-term relationships with them?
We do. So we do have a fixed contract, but we never fix a quantity. Like, for example, let's cement company, fertilizers companies like this, which we have in domestic market. We do have a fixed contract. So we are on the panel approved list as a supplier. So on a beginning of every month, we get the order for the next one. So it's a continuous cycle we got it.
And the prices also, especially in case of the cement companies and fertilizer companies, so they have a fixed policy wherein whenever there is a change in the price of raw material announced by the big players, so they immediately revise the price, whether it's upwards or downwards.
Okay. Give me a sense of how the market is doing for your polymers, especially since you're a consumer of polypropylene and HDPE. How is the prices moving there? And while you can't have supply contracts with the customers, can you have supply contracts with your suppliers so that the pricing can be fixed?
No, so we can't have a pricing contract with the suppliers. We buy in the spot market, but based on, we have done an analysis of last 5 years, so we could actually analyze the trend of the price movement. Based on that, we plan our procurement. At the same time, since our sales contract with our customer is short term, 2 months to 3 months, so there is no such risk of price volatility we are carrying, because it is passed on to our customer.
What would be the total kind of amount of borrowings after the issue? Means you're going to pay off 15 crores of your unsecured ones. You have taken 8 or 9 crores of long-term borrowing from the banks for your capex. What would be the total debt on your books after that?
So currently, the debt on the book as of 30th June is around 33 crores, and out of that, remaining debt in the books would be somewhere between 14 to 15 crores.
Okay. My final question to you is that there was a promoter company which had you know where I'm talking about the Aeroflex Industries, right? It's now a subsidiary or a promoter subsidiary now. What is the kind of RPT that you have with that kind of with that subsidiary currently?
So I would just like to clarify. So Aeroflex was not promoted by SAT Industries Limited. Aeroflex was actually a stressed company. It was taken over by SAT Industries Limited through ARCs in the year 2018. So earlier, before the takeover by SAT, it was a loss-making company, but now Aeroflex is a profitable and a dividend-paying company. And Sah Polymers and Aeroflex do not have any material RPTs.
Gentlemen, it's a pleasure talking to you today. Thank you very much for joining us on BQ Prime. Shah Polymers IPO opens on December 30th, price between 61 to 65 rupees a share. The fresh issue comprises of 66.3 crore rupees, which is going to be used for building a new facility, repayment of loans, and working capital. Thank you very much for joining IPO.
Thanks for
Thank
the
you so
opportunity.
much. Thank you.